Hi guys, this is Sia Jane and welcome back to my channel ACCA and beyond. Let's continue with our revision series, and today's chapter is going to be chapter number 7, which is evidence. Okay, so let's talk about audit evidence. Basically, the proof an auditor collects before giving their opinion, because obviously, no proof, no opinion. Now, according to ISA 500, the auditor's objective is to design and perform audit procedures in such a way that they collect sufficient appropriate audit evidence to draw reasonable conclusions. Sounds fancy, but it's actually simple. The auditor just needs enough quality evidence to be confident about their opinion. Not 100% certainty, just reasonable assurance. Because auditing isn't magic. Now, two key words you absolutely need to remember is sufficiency and appropriateness. Sufficiency is about quantity. Do we have enough evidence? And appropriateness is about quality. Is the evidence reliable and relevant? Now, what does sufficient actually mean? It just means enough evidence to support your conclusion. But here's the catch, enough is not fixed. It depends on the auditor's judgment. Auditors look at few key factors to decide how much evidence they need. First, risk of material misstatement. If the risk is high, they need more evidence. Simple. Second, materiality. If something is more important or has a bigger impact, again more evidence needed. Third, the nature of the system. Uh, if they have weak controls, more checking. Strong system, slightly less stress. Then they also consider results of control testing, their own knowledge and experience with the business, the size of the population, the sample size they are testing, and of course how reliable the evidence actually is. So yeah, it's not random at all. It's all calculated and based on judgment. Okay, so let's quickly level up an understanding of sufficient and appropriate evidence. Imagine you're auditing a bank balance. Uh, you confirm the year-end balance directly with the bank. Great, super, reliable evidence. But is that enough? No, because of timing differences. Some checks or cash might not have cleared yet. So what does the auditor do? They also check and reperform the bank reconciliations. Now, when you combine both bank confirmation and bank reconciliation, you actually have sufficient evidence. So remember, one evidence alone is not always enough. Now, let's talk about appropriate evidence, uh, which is also about quality. It has two parts, reliability and relevance. Focus on reliability. Auditors prefer evidence from independent external sources. The most, the evidence they collect themselves. And the least reliable, client generated evidence. Also, written evidence is better than oral, and original documents are better than copies. And here's the golden line, more reliable evidence means you need less of it. But if evidence is unreliable, no matter how much you collect, it's useless. Okay, so now let's quickly understand relevance uh, and its assertions. Relevance simply means the evidence must relate to what you're actually testing. For example, during an inventory count, the auditor does two similar looking procedures but for different purposes. First, they pick items from physical inventory and trace them to records. This checks completeness. Second, they pick items from records and trace them back to physical inventory. This checks existence. Same process, different direction, different process. That's what relevance is all about. Now, coming to the financial statement assertions. The whole point of auditing is to make sure the financial statements are free from material misstatement. To do that, auditors test transactions and balance based on assertions. In simple terms, assertions are just claims made by management, like these numbers are correct, complete, and properly presented. Auditors don't blindly trust these claims, they test them. So, assertions basically help auditors to identify what could go wrong and where error or fraud might exist. These are our assertions, and if you want a more, I'm going to revise these assertions in this video also, but if you want a more detailed or want a simple or better understanding of these assertions, I've created a video on that also. You can just find it on my channel. Okay, so the first assertion we are going to talk about is occurrence. Transactions actually happen and belong to the business. This is what it's all about. Second is completeness. Nothing is missing. Everything that could be recorded is recorded. Third is accuracy. Amounts are recorded correctly. Fourth, cutoff. Transactions are recorded in the correct accounting period. Next, classifications. Transactions are recorded in the right account. Next, presentation. Everything is properly described and disclosed. Now, assertions are for account balances at the year end. Uh, Sorry, I just have a little bit of cold. First is existence. Assets, liabilities, and equity actually exist. Next, rights and obligations. The business owns the asset and owns the liabilities. Next, completeness. All balances that should be recorded are recorded, again the same. Accuracy, valuation, and allocation. The amounts are correct and properly valued. Next, classification. Balances are in the perfect accounts. Next, presentation. Balances and disclosure are clearly shown and understandable. That's it. Learn these ones and you sorted for a lot of audit questions. Okay. Now let's talk about inventory misstatements. There are many ways inventory can go wrong. First, items may not be counted at all, which means the balance is not complete. Second, items received after year end might still be included, which means they didn't exist at the year end. Third, damaged or obsolete inventory may not be valued properly. Remember, it should be at lower of cost and net realizable value. Fourth, purchase cost might be recorded incorrectly, which directly affects valuation. And lastly, might some inventory might actually belong to a third party, so the company doesn't have the rights to include it. Now let's talk about disclosures. Disclosures are super important because they give extra information to users. If disclosures are poor, they can hide important details and confuse users. Some auditors sometimes don't give enough attention to disclosures, which is why it's a big focus area right now. So we move on to audit evidence now. Can you just give me 1 second? So let's understand how auditors actually get assurance from. There are two main ways: test of control and substantive procedures. Test of controls check whether the client's internal controls are working properly. Basically, are they preventing or detecting errors? Substantive procedures, on the other hand, directly check for mistakes in the numbers. Now, before deciding what to do, the auditor looks at audit risk. The audit risk model, if you remember, is inherent risk into control risk into detection risk. Internal control plays a huge role here. Stronger controls equals to lower control risk, lower chances of misstatement. But the auditor can't just trust controls blindly. They have to actually test them. So what did they do? They understand the system, document it, check it if it's well designed, test if it's properly working, and then decide how it affects the audit approach. Now, here is the key idea. Test of controls are not about amounts. For example, checking whether an invoice is authorized. It doesn't matter if it's about 100 or 1000 rupees. You're testing the control, not the number. So, test of controls give indirect evidence. If controls are strong, there's less chance of errors. But they don't actually verify the figures. That's where substantive procedures come in. They directly test the numbers in the financial statements. Uh, Substantive procedures are basically used to detect misstatements directly in the numbers. There are two types of test. There are two types: test of detail and substantive analytical procedures. Test of detail focus on individual transactions. For example, uh, okay, for example, checking one purchase invoice to verify its amount, date, and classification. But here's the catch: if there are 5,000 invoices, checking only one gives evidence for that one transaction. Now, analytical procedures are different. They look at the big picture. For example, comparing the change in purchases with the change in revenue. If they don't move as expected, something might be wrong. So, test of detail is a zoom in, and analytical procedure, you can say, is a zoom out. But analytical procedures have a limitation. They might miss errors if misstatements cancel each other out. That's why they're mainly used when internal controls are strong. Now, sometimes auditors rely on substantive procedures, like in small businesses or when controls are weak and can't be trusted. Um, but one golden rule is auditors must always perform substantive procedure on material items, and they do also do key checks like agreeing financial statement to accounting records and reviewing important journal entries. Okay, so let's move on to audit procedures. Auditors have a set of tools they use to collect evidence. These include inspection, observation, external confirmation, recalculation, reperformance, analytical procedures, and inquiry. Now let's quickly understand them quickly. Sorry. Inspection means checking documents, records, or even physical assets. It helps confirm things like ownership, accuracy, and even cut-off dates. When auditors Oh yes, sorry. When auditors physically check an asset like inventory, that's inspection of tangible assets, mainly to confirm existence and sometimes even valuation. Observation means watching a process being performed like an inventory count, but remember it only proves the control worked at that moment. Then we have uh, oh, yeah, so then we have external confirmation, getting direct responses from third parties like bank confirmations. This is one of the most reliable types of evidence. Um then recalculation is simply checking the math, making sure numbers are added correctly. Uh, Reperformance means the auditor redoes a control or procedures to see if it actually works. And analytical procedures looks at trends and relationships in data to spot unusual changes. Uh, okay, so 1 second. Okay, so let's understand analytical procedures as substantive tests. We have already seen analytical procedures at the planning stage, but here they are used to actually detect misstatements. Basically, they help identify trends and relationships in data. Now, important point: they don't directly find errors; they just highlight areas where errors might exist. So they can be used alone. They can't be used alone. They must be combined with other procedures like inquiry or test of detail. Auditors don't just compare with last year; they also compare with budgets or even industry data. Some techniques include ratio analysis, trend analysis, and proof in total, like estimating total payroll based like estimating total payroll. Sorry, can I just think of? Uh, I'm sorry, there was some disturbance. Okay. So, what's the advantage? They look at the big picture and can test multiple assertions at once. They also are used to support other evidence, like checking if management's explanation actually makes sense. But they only work well when the auditor can create a reliable expectation. If the business has changed a lot, or there are major one-off events, then the comparison becomes meaningless. Okay, so we have a four-step process for the to just quickly understand when analytical procedures can be used as substantive tests. First, develop an expectation. Second, decide whether the difference is acceptable. Third, compare the actual expected versus the actual. Fourth, investigate any differences. Simple, right? But whether this works depends on a few key factors. First, the assertions being tested. Analytical procedures are not good for checking existence. Like you can't prove inventory exists just using ratios, but they are useful for valuation, like identifying slow moving or obsolete inventory. Second, predictability. They work best when numbers follow a pattern, like payroll, cost, and number of employees. Third, reliability of data. Either data itself is weak or controls are poor, then analysis is basically built on shaky ground. Um, and lastly, the precision of expectation. If your expectation isn't accurate enough, you might have a material misstatement. Um, okay, so first, developing an expectation. The auditor can only create a good expectation if data is reliable. And here's a smart trick: the more detailed a data equals to more accuracy. Next, the difference between expected. Oh, sorry. Yes, the difference between expected and actual. The auditor C sets an acceptable level of variation. If the difference is small, all good. But if it's too big, more investigation is needed. Basically, big gap equals to red flag. Um, Now, finally, relying on the work of others. Auditors use experts, but there are two types. First is a management expert, sometimes hired by client to help prepare financial statements. Second, we have the auditor's expert, someone hired by the auditor to help gather audit evidence. Uh, First, let's talk about the management's expert. Before relying on their work, the auditor must check three things: are they competent? Are they objective? And is their work actually appropriate? So, basically, do they know what they're doing? Are they unbiased? And can we trust their work? For example, if the expert has no proper qualifications or experience, their work is not reliable. And if they're closely related to someone in the company, they could be biased, so again risky. Now, about the auditor's expert. This is when the auditor brings in their own expert because they don't have the technical knowledge needed. This usually happens in complex areas like valuation of property or financial instruments, actual calculation, oil and gas reserves, legal interpretations, or complex tax issues. But even here, the auditor can't blindly rely on them. They still have to check whether the expert's work is suitable for the audit. Even when the auditor uses an expert, they just can't blindly trust him. They must evaluate three things: that's competence, capability, and objectivity. So, how do they check competence? They do things like past experience, qualifications, professional memberships, discussions, and discussions with others, and even published work. Now, objectivity is a bit tricky, because experts might not follow the same ethical rules as auditors. So, the auditors check for relationships or interest with the client, discusses safeguards. Um, Next step, agreeing the work. The auditor and expert clearly decide what work will be done, who is responsible for what, and how they communicate, and confidentiality rules. Everything needs to be properly written. And finally, evaluating the work. Once the expert is done, the auditor reviews everything. Do the conclusion make sense? Are they consistent with other evidence? What assumptions were used? And the data is the data correct? Okay, so, yeah, even if an auditor uses an expert, they're still fully responsible for the audit opinion. They can't pass the blame. They must use their own judgment to decide if the expert's work is sufficient and appropriate. Also, in the normal audit report, the auditor usually does not mention the expert at all. Only in a modified opinion uh, can they refer to the expert, and even then, the responsibility does not reduce. Now, let's talk about internal audit. Internal audit is a part of the company's own control system. If it's strong and effective, it reduces control risk, which means the external auditor can do less detailed testing. Sometimes external auditors can even rely on internal audit work instead of doing everything themselves, but again, not blindly. They must first evaluate the internal audit function. They check things like, are internal auditors objective? Are they competent? Or do they follow a proper systematic approach? For objectivity, they look at things like, do internal auditors report to those charged with governance? Are they independent from daily operations? Are there any restrictions placed on them? You? Okay. Uh, okay, so the auditor can never transfer responsibility. No matter who helps, the final opinion is always the auditor's. And usually, the auditor doesn't mention using others at all. Uh, Sorry. Sorry, guys, for this video, I'll have to stop right here. But I'll continue where I've left off in the next video. So please stay tuned in and subscribe to my channel. And if you like this video, please do share it with friends and others. And thank you so much for watching.